Every industry has a moment when it stops being an experiment and becomes part of the system. For crypto, that moment is now. This is not the story of another bull run. It's not about meme coins, halving hype, or retail speculation. It's about something far bigger, the world quietly rewiring its financial infrastructure around blockchains. According to A16Z's State of Crypto 2025 report, this is the year crypto grew up, and the data speaks for itself. The total market cap has passed $4 trillion, double what it was 3 years ago. Blockchains process over 3,400 transactions per second, a 100-fold leap from 2020. Stablecoins have settled $46 trillion in the last 12 months, $9 trillion of that adjusted for real organic activity, and more than $175 billion now sits in Bitcoin and Ethereum exchange-traded products, assets directly held by public markets and institutions. Crypto is no longer the rebellious outcast on the edge of finance. It's becoming the plumbing beneath it. It moves faster, costs less, and now connects more people than any traditional payment network ever built. But this moment didn't come easily. 3 years ago, crypto was still in its adolescence, volatile, misunderstood, and under attack. 2022 brought collapses, lawsuits, and a regulatory crackdown that scared off capital and talent. At the same time, the explosion of AI pulled thousands of developers away. Those were the dark days of the industry. Yet through all of it, the builders stayed. They rebuilt the foundations, scaling networks, cutting costs, and solving the problems that once made crypto impractical. Now, those years of quiet development have delivered a technology stack that's faster, cheaper, and ready for global adoption. That's what A16Z means when it says the industry has matured. The market is no longer waiting for the next speculative mania. It's building the next generation of financial infrastructure. Before we continue, if you want to stay ahead of these macro shifts, make sure you're subscribed to the Crypto Nutshell, our free 5-minute daily newsletter read by tens of thousands of investors who want sharp, actionable insights without the noise. First link in the description. All right, let's get back to the video. Institutional adoption isn't a prediction anymore. It's measurable reality. Look at the logos: Visa, BlackRock, Fidelity, JP Morgan, PayPal, Stripe, Robinhood. Not just press releases, real products, live integrations, millions of users. Traditional banks and fintechs are rolling out crypto trading, custody, and payments side by side with equities and ETFs. Fintech challenges like Circle, Stripe, and Robinhood are even building their own blockchains for stablecoins, real-world assets, and payments. They're no longer dabbling, they're competing. That change wasn't just about market opportunity, it was about policy. In 2024 and 2025, the US regulatory stance flipped. The Genius Act created a clear framework for stablecoins. The Clarity Act set rules for token oversight and exchange operations. And Executive Order 14,178 formally reversed the previous anti-crypto directives, establishing a cross-agency task force to modernize digital asset policy. For the first time, builders and institutions have a green light to operate inside the system, not outside it. That's why exchange-traded products exploded from $65 billion to $175 billion in a single year. Public digital asset treasury companies now hold about 4% of all Bitcoin and Ethereum, and when you include ETFs, that figure climbs to nearly 10% of total supply. In short, crypto is no longer fighting for legitimacy. It has it, and the United States, once its biggest obstacle, is now positioning itself as its largest champion. Crypto's expansion isn't happening in one geography, it's happening everywhere, but for different reasons. In Argentina, Colombia, India, and Nigeria, crypto is survival. When local currencies collapse and banks restrict withdrawals, stablecoins become lifelines. In Argentina alone, mobile wallet usage has risen 16-fold in 3 years. People don't speculate, they transact. In Australia and South Korea, it's the opposite story. Trading volumes and token traffic dominate activity. Speculation drives engagement, and through that, liquidity. Two distinct use cases, but both strengthening the same network effect. More users, more relevance, more resilience. A 16Z estimates between 40 and 70 million people actively transact on-chain. That's up 10 million from last year, but still a fraction of the 716 million people who own crypto. Less than 1 in 10 holders actually use their assets. That's the untapped frontier. Hundreds of millions of people holding a key they've never turned. As wallets, identity systems, and applications become simpler, that gap will close. And when it does, adoption will compound fast. The clearest proof that crypto has gone mainstream lies in stablecoins. They're no longer a niche trading tool. They're a core payment layer of the global economy. $46 trillion in annual transactions, $9 trillion in adjusted organic volume, more than $300 billion in circulating supply, with USDT and USDC commanding 87% of the market. Over 1% of all US dollars now exist as tokenized stablecoins. Together, they hold $150 billion in US Treasuries, making them a top 20 holder of American debt, ahead of many countries. And because 99.8% of stablecoins are denominated in dollars, they've quietly become a tool of US monetary influence. Stablecoins aren't replacing the dollar, they're amplifying it. As foreign central banks diversify away from treasuries and toward gold, stablecoins have emerged as the new demand engine for US debt. They've turned dollar liquidity into a global programmable API, a system that moves in seconds, not days. This is what the world coming on-chain actually looks like. The next transformation is happening inside the system itself. DeFi isn't just surviving, it's thriving. Decentralized exchanges now process nearly 20% of global spot volume. Perpetual futures have exploded, generating trillions in trades and over $1 billion in annualized revenue. Price discovery is drifting away from centralized venues. When DeFi hits 50%, markets will start looking on-chain first for the true price of every asset. At the same time, the on-chain economy is expanding far beyond finance. Tokenized real-world assets have reached $30 billion, a fourfold increase in 2 years. They bridge traditional capital markets and blockchain rails, turning treasuries, money market funds, and even private credit into instantly transferable digital assets. Then there's DePIN, decentralized physical infrastructure networks, where crypto coordinates real-world hardware. Helium's grassroots 5G network now supports 1.4 million daily users across 111,000 hotspots. It's not theory, it's running. Prediction markets have re-emerged as well. After dominating the 2024 election cycle, platforms like Polymarket and Kalshi are now 5 times larger, expanding into sports and real-world events. Even memecoins, for all their chaos, served a purpose. They pulled millions of new users into crypto ecosystems that later found more productive outlets. Every one of these categories, from RWAS to DEPIN, shares a common trait: composability. When applications can interact on a shared settlement layer, innovation compounds like software did on the early internet. That's the engine of the next decade. 5 years ago, blockchains were bottlenecked by cost and capacity. Today, that bottleneck is gone. Aggregate throughput now exceeds 3,400 transactions per second across major networks. Ethereum's Layer 2s have driven average fees down from $24 to under 1 cent. Solana's high-performance architecture now powers everything from DePIN projects to NFT marketplaces and generated $3 billion in annual revenue. What used to be a scaling problem has become a product problem. The limits now are UX, regulation, and education, not hardware or math. And that's why A16Z introduced a new core metric: real economic value, the actual fees people are paying to use block space. It's the purest signal of genuine demand. In 2025, 2 ecosystems, Hyperliquid and Solana, captured over half of that value, marking a shift from the long-standing dominance of Bitcoin and Ethereum. Bitcoin, meanwhile, has fully embraced its digital gold identity. Ethereum and Solana have become economic engines, programmable layers that settle payments, collateralize assets, and power on-chain businesses. Each network now serves a distinct economic niche. Regulation is reinforcing that differentiation. With the Genius Act and agency alignment, tokens can now legally distribute protocol revenue under clear conditions. That unlocks a new model of ownership, one where users can hold, use, and earn from the same system. It's the final piece of the loop. Usage creates fees, fees create yield, and yield attracts more usage. The internet never had an internal economy before. Now it does. If 2023 was the year AI went mainstream, 2025 is the year crypto met it halfway. AI is powerful, but dangerously centralized. 2 companies dominate the AI model space, 3 control most of the cloud infrastructure, and 1 manufacturer supplies nearly all the GPUs. That concentration has fueled record profits and growing anxiety about control. Crypto is the natural counterbalance. It decentralizes the very things AI centralizes: identity, data ownership, and payments. Proof of human systems like World have already verified more than 17 million people, creating a global identity layer that distinguishes humans from bots. Meanwhile, the X402 protocol is emerging as a payment backbone for autonomous agents, enabling machines to make microtransactions, access APIs, and settle instantly without banks. Gartner estimates this machine-to-machine economy could reach $30 trillion by 2030. and it will need crypto rails to function. AI agents will use stablecoins first, but over time, they'll borrow, lend, and trade on-chain by default. As Eddie Lazarin put it, when institutions come for stablecoins, they stay for crypto. The same logic applies to machines. The rails they start on will determine the economy they build. 17 years after the Bitcoin white paper, the industry is stepping into adulthood and thinking decades ahead. Privacy is back on the roadmap. Zero-knowledge proofs are no longer academic curiosities. They're becoming essential infrastructure. Compliant private stablecoins are gaining traction, and the post-quantum transition is already being planned. Roughly $750 billion in Bitcoin sits in addresses vulnerable to future quantum attacks, but roadmaps are forming years in advance to secure them. That's what maturity looks like, preparing for existential risk before it arrives. So what comes next? 3 clear imperatives stand out. First, think rails, not rallies. The biggest upside now lies in the infrastructure: payments, identity, data, and liquidity systems that everyone else builds on. Second, own the distribution. Institutions have reach. Builders who integrate with their systems will capture users faster and cheaper than ever before. Third, design for conversion. 700 million people already own crypto. Fewer than 70 million actually use it. The products that close that gap will define the next cycle. And about that cycle, is it over? A 16Z's analysts say this run looked unlike any before it. The 2024 to 2025 surge wasn't driven by innovation. It was driven by access. ETFs and liquidity opened the gates. The next rally will be driven by builders. When the next generation of products go live, payments, identity, AI integration, that's when the real adoption wave begins. Crypto is no longer guessing what it might become. It knows what it is. It's infrastructure for the digital economy. The pipes are built. The users are coming. Institutions are here. Policy is catching up. Finance has officially gone on-chain. If you enjoyed this breakdown, consider subscribing to the channel. It helps the channel grow, and you can always change your mind later. See you all in the next one.